Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, April 10th, 4:52 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend, a bifurcated uptrend as small caps, mid caps continue to lag, as well as specific sectors, which we saw due to the bank liquidity crisis and also rotation out of recession fears last week. Check over here at the trend gauge. We've still got leaders holding up okay, although the G6 has not been okay. In fact, the more charts I looked at over the weekend, the more bearish I got. But then, after summing all things up, putting my thoughts together, I realized you can't be bearish until this happens, and I'll go through the this happens later on in this video. So still showing bullish. Leaders, really what they do is they're pulling back to constructive areas, and then they're bouncing maybe 4, 5, 6, 7% before giving up and pulling back again. It's really a tough environment to make progress in. Really, most of the gains we've been getting have been off of the index ETFs, with the S&P 500 and the Nasdaq pulling back to support and bouncing off of support. And we'll go through the tail of the tape in the charts, and we'll reinforce this momentarily. So short term, showing uptrend. The big cap indexes look fine. Mid cap and small cap don't. That's across our short term 21-day moving average, also across our medium term 50-day moving average on the 5 major indexes. We're showing neutral there, as well as long term. Same situation relative to the 200-day moving average. So what happened today? Pre-market, there was some strange news out of Japan. The futures were about flat, and then the new Bank of Japan president was expected to be more hawkish. They actually still have their benchmark short-term rate negative over there, negative 0.1%, and he was expected to get more hawkish, and he didn't. He said, we're just going to keep things the way they are. The yen dumped when that happened. The yen dumping means the dollar is going to surge, and it did. And the strong dollar brought the indexes down to their pre-market lows just as we were opening. We ended up gapping down across all of the indexes, but bottomed within the first 30 minutes. One harsh pullback during the day, and then we chugged higher into the close to close near the high of the day. A win for the bulls after an ominous looking open. Gap down, positive reversal to green, almost green across the board. The NASDAQ 100 still slightly red. This was actually a pretty good performance for the NASDAQ 100, considering Apple was down 1.6% and Google was down 1.8%. So here are the final numbers. RG7, this is our 7 ETF growth composite, had its best day that it's had in a while, up almost 1%. S&P 500 battled back from the 0.6% gap down to close near the high of the day, up 0.1%. I mentioned the NASDAQ finishing green. The Dow gap down 0.3%, finished positive by 0.3%. NASDAQ 100, by the way, gap down almost a full percent before staging its comeback. Mid caps, nice day, up 1.23%. And I've got this number wrong here. The small caps were up 1.02%. Global diversified 60-40 negative. Bonds showed serious price weakness today across the board, which means yields were higher, but that drug the global 60-40 to negative 0.18%. GROTECTION down 0.06%. It was our bond position that we took last week that made up the brunt of the losses. We'd have been positive except for the bond aspect of it, but a portfolio is a portfolio. Those are the numbers. Let's get right into it. We'll take a look at the major index charts, the asset correlation charts, and then we'll go to the tail of the tape and the charts that I really want to take a look at. So here's the S&P 500. Let's go to a 5-minute. You can see the big gap down. tested lows from last week. There's a big support area around 40.70. We held it early, rallied up to 40.90, tried to sell off, harsh sell off again here, but held 40.75. Just as quickly as we came down, we bounced to highs of the day, then a nice higher high, higher low trend into the close from for the last 3 hours, closing near the high of the day. Let's back this up to the 60-minute chart so you can see what I'm talking about here. This critical 40.70-ish, 40, yeah, let's 40.70 to 40.80-ish area. It was support 2 days last week. It was where we broke above last week when we had the gap up and then the follow through day. And the highs from last week, 41.33, are the next resistance area that we need to overcome. But for now, to each of the last 2 days, the S&P 500 bounced at the ADMA. If you can't even close below the ADMA, it's hard to be bearish no matter how some of the action looks. And late last week, really most of last week, there was rotation out of leadership into defensives. But they held. A lot of them bounced at the 21, undercut, reclaimed the 21, bounced at the 50-day, and that's what they need to do. And if they're not breaking down, the indices are not going to break down. So there's the S&P 500. Here's the Nasdaq 100. Undercut, reclaim the ADMA again, very similar to what it did last week. And again, until and this pivot, this 313.68-ish pivot, we keep pulling back and holding that. So the lows of Friday and the lows of today are critical. Right beneath there is the 21-day moving average. That's the worst that we would want to see for a pullback. And as always, we keep our eyes peeled to what's going on. Dow Jones Industrial Average. Outside positive reversal, didn't even touch the ADMA, continues to show some relative strength. Good stuff for the Dow, above all of the major indexes. And some of the stocks that were really dragging the Dow lower 3 or 4 weeks ago have made recoveries, U-turns, gotten back above the 200-day moving average. And these are primarily several higher priced healthcare stocks taking care of that. Remember, healthcare is a defensive sector where money tends to rotate into during recessionary fear times. Here's mid caps. We got a single close above the 21-day moving average today, reclaiming the 8 and the 200 at the same time. So finally, some relative strength you can see here on mid caps. Relative strength made a new low well before price did, which is obviously bearish. But first thing we need to do is for broad market exposure is to make the mid cap and small cap stop going down. There looks like they're holding this shakeout of the 320 shakeout lows of 324 right now. We finally got back above the ADMA on small caps. 21 EMA is above that. So those are the 5 major indexes. Let's go to the dollar. And I mentioned with the yen gapping down that the dollar gapped up, and that corresponded with weakness, but the dollar kind of dripped lower all day. And as it dripped lower, the indices trickled higher, particularly in the afternoon. Daily chart, we ran into the declining 21-day. We've been below that for 2.5 weeks. But note we're coming off oversold on the stochastic. And if the dollar wants to rally, it's going to be a headwind for stocks. This is something we'll be paying close attention to. Obviously, the weak dollar has been a benefit to precious metals and precious metal stocks. That will flip if the dollar starts showing some strength. How about the VIX? VIX was, with the gap down, the VIX was up quite a bit early, ran into this 20 area. Look how 20 has been a cap on the VIX for the last 2 weeks, closing repeatedly near the lows of the day, which is actually bull market action, because bull markets, the markets open weak and close strong. VIX doing just the opposite, opening strong and closing weak. And still below the declining 21-day moving average. That's a benefit for stocks, although it is in the area where it has bounced typically and is also oversold. So It's always a wall of worry of varying indicators to climb your way higher in this market, and that's how it's been for 15, 16 months now. So there's the VIX. Let's flip to bonds. BND, broad bond index, down 0.67. Got near the top of this range, looking to break out last week. This is a pretty big gap down here, and it's something we want to be paying attention to. Same situation with TLT. Actually broke out or tried to break out last week. Had a new closing high at 108, 108.53. So not a new closing high, 109.35 there, but above the 200-day moving average gap down here. We want to see if this is a change in trend. It was after 5-6 straight up days in the price, meaning the yield dropping. So we'll keep our eye on that also. What did that mean for yields? That means that they're going higher. Let's start with the 10-year, the TNX. Was this a fault? First, we were wondering if this was a false breakdown. Then we made a lower low for 2 days. Is this a false breakdown? So again, we'll keep an eye on that gap up. This is sort of a morning star-ish type pattern, although it's stretched out to 4 days and not just 3 days. And then TYX, the 30-year. Didn't make the spike lower low the way the 10-year did, but recouped the 200-day moving average today. But again, this was after 7 straight down days, pullbacks on the yield. So yields popped on the day. How about gold and silver? We talked about how the dollar was strong. GLD putting on the brakes, down 0.74%. 3-day pullback now for that. GDX down 1.28%, first day of a pullback after 4 straight up days. SLV silver basically flat on the day, consolidating in a tight range, 4 tight closes on SLV. So it's holding this breakout above this 2250 area. And then kind of the surprise of the day, Bitcoin trying to break out. Note, we've been talking about how this has been contracting, very tight ranges. Let's go to the 60-minute chart on this. You can see the big move up this afternoon, not quite a pullback. Near these highs, this corresponds with like 29,000 and change on Bitcoin. Trying for a breakout, not quite there yet after 1, 2, 3, 4 days of tight action. So those are the major indexes. Let's go to the tail of the tape now. You can pause this, read through the whole thing. I'll hit the highlights. Here's the news that I talked about with the new Bank of Japan president unexpectedly keeping short-term rates negative. We've got CPI Wednesday. We've been trading in a tight range for 6 days. I would expect a move to happen one way or the other based on this CPI data. Our day count, I changed this to a 6-day consolidation, which is what we're in. 11 days above the 80 EMA and the 21 EMA. FOMC odds have now flipped to 74% in favor of a 25 basis point hike, which is a bit surprising considering all the bad economic data that has been coming out lately. Expectations positive as long as we're holding above the 21 on the S&P and the NASDAQ. That continues to be confirmed. We undercut and reclaimed the support resistance levels. I talked about the action here, the sectors that were hot and cold on the day. Here's our portfolio. Sold PAN-W, that's in yellow. We bought ONON back when it reclaimed a key moving average and back above the 30 resistance level. It failed a couple times at 30, then it reclaimed it and held it on a pullback. We got back in with a pilot buy on that. So our adjusted beta staying about the same, about 1.1. And as far as the title of this video, hard to be bearish until these charts break, we're going to look at these big cap leaders, and the market simply can't go lower as long as these stocks hold up. There's about 25 of them. They're heavily weighted across the 3 major indexes, and probably 80% of the charts look pretty darn good until they break. Because of their heavy weighting, the market simply can't break. I mean, if all you do is invest in mid caps and small caps, you've had a hard time of it. Our indicators have been telling us to stay away from it, and we're focusing on the action of these big cap leaders. because of the weight in the indexes. So the bottom line for today, gap down, but a positive reversal higher to close green. Bulls just won't give up at this point. And we're going to take a look at these charts for some insight as to why they won't give up. And we're going to start off with the Dow Jones Industrial Average. So the top, let's see, the top 10 stocks make up 50% there's 30 stocks in the Dow, obviously. The top 10 make up 50% because of their price weighting. So we're just going to go through these top 10 here. United Healthcare, this was a big drag, but it's gone from 450 to 515 over the last week and a half. Reclaiming the 200-day moving average, it got a big upgrade. It's got earnings this week. We'll see how those earnings are the reaction to them, but their numbers haven't been bad at all. It's got a PE of 23, 24 earnings, up 15%. So it's a leader. It's by far the biggest leader. The next stock down is Goldman, and it trades almost $200 lower. So this thing is dominating how the Dow is acting, and it's playing a big part as to why the Dow has come back higher recently after lagging while it was pulling back. Now Goldman's lagging, quite obviously. Needs to get above the 21-day moving average. Microsoft, very strong chart. Recently broke out, riding the ADMA higher. Home Depot, another weak one below the 200-day moving average. McDonald's, recent upgrade, breaking out of this flat base. Nice relative strength there. Amgen, not all biotechs are acting well, but Amgen got back above the 200-day moving average and is battling to stay there. Visa, this is a nice looking base, flat or cup and handle-ish if the handle is another couple days longer, but there's nothing wrong with that chart. Boeing making, tightening up again, putting in a little bit of a handle. This is only a 13% deep base, and that looks pretty darn good. Caterpillar holding the 200-day moving average after a strong move down and three tough down days last week, as this was really getting hammered when the industrials were getting hammered as part of the recession rotation, but undercut reclaim on above average volume of the 200-day moving average today. Important that that holds. And finally, number 10 is Salesforce. Nothing wrong with this chart. Gap up on earnings, pull back to the 21 held, riding the ADMA higher, now pulling back and holding the 21. So those make up 50% of the Dow. There were only two bad charts in there, Home Depot and Goldman. Let's move to the NASDAQ 100 now. NASDAQ 100, I'm going to here's the weighting. So I'm going to bring this in. You can pause it and read this. But these I'm going to call it top 12 because Google, it has both share classes in here. These top 12 make up 60% of the NASDAQ 100. Let's fly through these charts and you'll see, they look okay. And as long as they look okay, the NASDAQ 100 is going to hold up fine. And a lot of these play a big role in the S&P 500 also. Here's Apple pulling back today. Apparently their shipments were down 40% on their MacBooks. All it did is bounce off the 21-day moving average on below average volume. So nobody's selling Apple on that news. Microsoft, you already looked at this, riding the ADMA higher. Amazon, in a tight range below the 200-day moving average, but riding the 50 and the 21-day moving average is higher. Google tried to break out Friday of this cup and handle, lower volume pullback today, down 1.83%, but they're trying to be a big player in AI also. And they've said they're going to integrate AI in with their chat service or with their Google, with their search engine. So it is the preeminent search engine. They've got YouTube. That's a nice looking chart. That's just the second share class. NVIDIA, we own this, continues to be on a tear this year. It bounced off the 21 twice. A little bit of a lack of relative strength lately, but a very nice day today, up 2%. Meta, are they in Meta? Are they in AI? Since they announced that they gapped up on their last earnings report, they've got their next earnings in 3 weeks. Since they announced that they formed an AI division, it's been showing serious relative strength, riding the ADMA higher. No matter what you think, again, about these companies, until the charts break down, the indexes can't break down. Tesla, one of the weakest, broke below the key moving averages last week, gapped down today on a price cuts and some kind of a class action lawsuit, but closed to near break even by the end of the day. This is the weakest chart in there in the top 10. AVGO Broadcom bounced at the 50-day today. Pepsi, nothing wrong with that chart either, forming a very nice base. Costco is number 10. Gap down on weak same store sales. It's higher than that now. So this is a case of a gap down on bad news getting bought up, and it was up 1.62% today, trying to reclaim its moving averages. Cisco holding the 21-day tight action base on base pattern. T-Mobile, uh, nice tight action forming a long flat base. So again, until these stocks break down, the indexes are just can't break down because frankly, it's just the math involved in the weightings, and the market can't fall if the stocks that make it up don't fall. And now finally, let's go to the S&P 500. 33% of the S&P 500 is in these 14 tickers. Again, same thing with Alphabet. I'm not going to show, I'm just going to show the ones that I haven't shown yet. BRKB. This is number 1, 2, 3, 4, 5, number 6 in the S&P 500. By far the best looking financial chart that you'll see. We talked in-house that if we ended up shorting financials, we would go long Berkshire Hathaway to offset it, as this is the biggest component of XLF. So it's going to act as a way to keep the XLF up while the weaker holdings in there try to break down. We showed Tesla, we showed Meta, we showed United Health, we didn't show Exxon, but this gapped up on the oil production cut news last week, and it's held it. They announced that they're thinking about doing an acquisition today, but this is a pretty nice chart. It's forming the right side of its base here, and it would be a stage 1 base because it undercut this prior flat base. Johnson and Johnson, uh, weak, very weak. This is one of the ones that was holding the Dow down, but gap up on their talc lawsuit settlement last week, trying to get above the 200-day moving average. The chart certainly improved over the last week. JP Morgan, again, banks haven't been doing too well at all, but this one is holding the 200-day moving average. Visa, we already showed that, and finally Procter and Gamble. You know, in times of a recession, money flows into staples, and Procter and Gamble is the leader here. Pulled back today, 7 straight up days, 8 straight up days. After some of the recession fears started coming out in the news. So, you know, these 14 stocks make up, again, 30%, 33% of the S&P 500, and if they hold up, the indexes have to hold up. Uh, it's that simple. You can look at breadth all you want to, with mid caps and small caps being weak, but as long as these big weights hold up, the indices are going to hold up. And with that, we're going to wrap it. Remember, at Revere, we always say it's not how much you make, it's how much you keep. Our number one job is to avoid these bear markets. They all occur below the 200-day moving average. We're above the 200-day moving average, so that's why we've been taking positions. Recently, some have worked, some haven't. But if you just read the headlines, and me looking at like I said, looking at charts, the more growth charts I looked at, the more bearish I got. Then I started looking at these big cap charts, realized the weights and leaders can sell off. But as long as these big cap stocks don't, the market's going to hold up. So with that, I'm going to wrap it. So wrapping up Monday, April 10th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.